Hello, everyone. Welcome to Kudlow. I'm Larry Kudlow. I want to begin this evening with some thoughts on today's Senate hearing with Treasury Secretary Janet Yellen and Fed Chair Jay Powell. And the hearing had the perfectly awful title, CARES Act Oversight of the Treasury and Federal Reserve, supporting an equitable pandemic recovery, end quote. Our first guest, by the way, is Senator Pat Toomey, and he attended the hearing. He's going to give us his curbside report. But I want to note that during this pandemic emergency period, going all the way back to February 2020 last year, I want to talk about the Federal Reserve. The Federal Reserve has truly done its part to inject cash into the economy. By our calculations, over the past 18 months, the Fed has actually basically doubled its balance sheet from $4.1 trillion to $8.3 trillion. So essentially, they injected over $4 trillion of new cash into the economy. Another way of looking at it, through the M2 money supply, which has jumped from $15.5 trillion to $20.5 trillion. That's a gain of $5 trillion, or 32%. Now, these are numbers that you folks out there probably don't care about, all right? I get it. We're getting into the weeds here, but I like the weeds. I started my career in the weeds some 48 years ago in open market operations at the New York Fed. Yes, indeed. The only reason I'm putting these numbers on the table tonight is to show you just how big they are. In other words, while emergency pandemic relief fiscal policy spent about $4 trillion last year, another $2 trillion this past winter, and possibly headed for $6 trillion in the next month or two, Save America, kill that bill, the Fed is doing its part by pumping in $4 trillion of high-powered cash, leading to a $5 trillion jump in the nation's money supply. Now, all that Fed new money was basically sitting idle for much of last year. In the heart of the pandemic, the government shut down, the economy was shut down. Most folks were playing defense. They were hoarding their cash. They were avoiding risk. So the money supply really wasn't inflationary. But as the economy has reopened through the vaccine miracle of Operation Warp Speed, the Fed's continued pump priming right now really begins to threaten a longer-term inflation problem. Now, excess money is different from pandemic shortages in the economy, although it takes longer for market forces to heal those supply chain problems. Continued Fed cash injections is really completely different, and it's a very worrisome matter. There is a connection between massive federal overspending, federal government overspending, and massive Federal Reserve overpumping. Think of it this way. While the budget deficits pile up, the Fed seems to be financing government spending and borrowing. For example, over the past 18 months, the central bank has purchased, get this, 57% of the new marketable Treasury debt that was issued. 57%. That is not supposed to happen, folks. You can go all the way back to the 1951 Fed Treasury Accord, where the Fed stopped pegging long-term interest rates and stopped buying wartime bonds. In fact, you could go all the way back to the 1913 original Federal Reserve Act, where the central bank's main purpose then was to provide an institutionalized currency elasticity, but not to finance government spending and borrowing. I remember it well. I was there. That's a joke. In Latin America, by the by, and in some other places, central banks do buy all the government's debt and print all the money and inflate the economy and destroy the currency. Now, fortunately, we're not there yet. In fact, King Dollar is strong and reliable. It's good. It's very good. Gold hasn't moved in quite some time. However, commodity prices are on the rise, suggesting Powell and company are still too loose. And even the CPI break-evens in the inflation-adjusted Treasury bond market are showing gradually higher inflation expectations. By the way, the 10-year bond is now up to about $1.55. So I must say I'm getting worried about inflation. And frankly, the Fed should have stopped buying mortgage bonds 6 months ago. Now, maybe they're going to taper down their portfolio purchases in a couple of months, but who knows? And I will say the rise in long-term bond rates in recent weeks could be signaling the Fed it's time to raise their target rate, the Fed funds rate, before serious inflation breaks out. Meanwhile, the Fed, and I presume the White House, were right to dump the Dallas and Boston Fed presidents for trading stocks and bonds. That's a big no-no. By the way, we couldn't do anything like that in the executive branch. But I am really concerned that more and more federal spending and more federal borrowing puts more and more pressure on our central bank to finance the Democrats' big government socialism, cradle-to-grave, welfare dependency assault on work and wages and jobs and prosperity. Remember, the Fed has an important tradition of independence. But if they cater to the Dems' far-left progressive wish list, and if they finance it, they're going to lose their independence. We will lose the inflation race, and we will lose King Dollar in the process. And that would be most unfortunate. So that's my riff for this evening.